Well, Treasuries right now unchanged, slightly lower this morning. Yields on the 10-year back down near 3.72%. Now, our guest says yields can go to 4%, but not necessarily stay there. Says it's a benchmark. For more, we turn to Sean Maloney, as fixed income strategist at Nomura International. He formerly covered central banks for RBS and worked at the Reserve Bank of Australia. Sean, we're glad to have you with us this morning. So you say that 4% level is a benchmark. I mean, does that just scream, buy me, buy me, buy me?
Yeah, I think it does. I mean, we saw it briefly touched last week, and the market saw some very strong support come in. And I think that's just put a base under the market for the time being. And with the supply burden just for the momentarily here, easing down to a fair extent, it just seems like the market has some legs to certainly find some support on any dip back to that level.
I mean, there's been a huge split opinion, Sean, all year. I mean, whether or not Treasuries are overbought. What's the final word as you look out to the rest of the year?
Well, I think you could probably argue with hindsight that there was certainly a time where they were overbought. But having said that, we've had a significant sell-off from that point. And the price action that we've seen more recently suggests to us that the market is getting to a more balanced state now, where the sensitivities to both upside and downside risks are roughly the same. So, I mean, if anything, we think probably the movements last week perhaps left the market a little bit oversold. But, you know, we do expect a fairly two-way period of activity from here.
What's the most significant data point or idea do you think driving sentiment right now, Sean? I mean, is it risk appetite? Is it worries about inflation? I mean, if you had to pick one factor that's just dominating the Treasury market, what is it?
I'd say right now it is this realisation, if you like, that the economic data that we've been seeing, while there has been improvement in these numbers, they have been off very low levels. And I think it's just dawning on a lot of participants in the market that the type of recovery that we're going to see out of this financial crisis might be a little bit slower and somewhat more different than what we've seen in the past.
What does that mean as far as the inflation story goes? I mean, do you think then that the inflation story is being overplayed, that risk is being overestimated?
That is certainly our view. We think that while inflation could become an issue further down the track, depending on how the Federal Reserve conducts its policies once the economy really does start recovering, for the moment it just seems well and truly premature to be talking about it, given that inflation rates are in negative territory at the moment, and there's not a great deal on the horizon to suggest that that's going to change in the near future.
On a scale of 1 to 10, Sean, how confident are you that the Fed is, when the time is right, going to be able to sop up extra liquidity? I am, on a scale of 1 to 10, I'd say about 8. The sort of nuances that we've seen coming out of the Fed suggest that they are very wary of the issue. A lot of the programs that they've got in place will unwind naturally as the economy improves. And I think that the fact that they're even giving lip service to the inflation story and the need for exit strategies suggests to us that they will be well in control when the time comes. Sean, before we let you go, where is the best value right now on the curve?
Well, we have seen a significant steepening in the curve since the beginning of the year. That's just started to unravel in the last couple of weeks or so. And we think probably that the degree to where long-end yields have got to, that is probably the best value in the curve for the moment, and we see scope for further flattening going forward.
Sean, we thank you very much. Sean Maloney, fixed income strategist at Nomura International.